Oracle stock has rocketed 26% after signing huge AI deals, and it's now being talked in the same breath as Nvidia. So clearly Oracle is no longer a dark horse in AI. The caliber of contracts is winning absolutely proves that, and in fact in their latest quarter alone they signed 4 multi-billion-dollar contracts with 3 major customers, sending their backlog soaring 359%. In fact, if we just look at the breakdown of their latest earnings, their cloud revenue is also gaining momentum, up 28% year on year. So this is the catch that we really want to highlight. Even after the incredible run this company has had, in just the last 5 days is up 25%, year to date up 78%, over the last 12 months it's up 88%. The company is currently on a little bit of a pullback, we're talking around 10%. We also notice Wall Street does have a buy rating of 4.33, very nearly 4.5 to flip this into a strong buy, but we're also seeing that the valuation metrics are all flashing red. For example, if we take a look at the valuation on a forward P, it sits around 43, which is more than double its 5-year average, seeing an 18.8, which in isolation alone screams overvaluation. Now, we never look at these models in pure isolation. In fact, methods like the blue tunnel methodology helps frame the intrinsic and fair value more accurately, and that is what we have highlighted in the blue tunnel itself. Yet we're noticing massive disparity from where the company sits today and even the upper end. This is what we would call severely overvalued, something the territory it has been in the last 12 months. And in fact, if we zoom out to the last 5 years, this is a trend the company has kept up from around the beginning of 2023. But it's also worth noting across the entire S&P 500, forward Ps are extremely elevated, and Oracle is no different. That's also reflective when we look at a price to earnings growth. On a PG basis, again, majority of the market is sitting in the red, bit of an alert signal, and again, Oracle is no exception. So that's why in today's video, we're focusing on AI stocks that still have strong growth potential, haven't run up as much as we would expect for the quality, and as a nice bonus, those that actually pay dividends. Now, jumping into stock number 1, it is Taiwan Semiconductors, and it was just months ago that we heard that due to the massive chip demand they're having, they're looking to speed up the expansion that they have in Arizona, and just released days ago their August sales are up around 34%. It really shows that AI demand isn't slowing down and that TSM are really taking advantage, with the expectation that next month is also seeing a very large drive. We're talking in the double-digit region. It's also worth flagging that their official previous quarter top line was up 44% year on year, but it's not only the revenue growth we like about the company, it's also the way they're able to increase their margins, efficiencies on the gross profit up 5 percentage points, 7 on the operating side and 6 on the bottom line net income. Now, yes, the company has run up 52% in the last year. Year to date, it's also up around 30%. And in fact, in the last 10 years, this one has massively outperformed the S&P, but we do believe it is one for serious consideration, trading very near to its all-time high. In fact, Wall Street and Quant also in agreement with a double strong buy, which is fairly rare to see on the channel. Seeking Alpha also giving it a buy, 4.3 out of 5, and we notice the growth also looks very strong, especially when you consider that typically this is in a cyclical industry. We're talking 39% year on year, 27% expected for the full year. On both accounts, it's above the sector in comparison, but also they're growing faster than they have done in terms of their 5-year average, and earnings per share also looking very promising, 22% projected in the next 3 to 5 years, above sector at 15 and their own historical of 19.3. And it doesn't stop there, we see green right across the board when we're looking at their earnings as well as expectations. 100% track record in the last 4, essentially outperforming analysts, and they're expecting the next 4 to be growth, with the majority at a double-digit rate, focusing on 2026 earnings per share, giving the forward P on those projections below 23. And yes, we do notice forward valuation 25.7 is above the 5-year of 22, but when you compare this to others, it is looking very, very attractive, and the yield also 1.3 below the 5-year of 1.7. Both accounts, as we always say, in isolation, we don't look at them, but this does highlight potential overvaluation, something that is noted when we do look at the blue tunnel. Again, Liberation Day, you could have bought this severely undervalued, as we did state in previous episodes, so make sure you're subscribed, notification bell is on. When we see super high quality companies like TSM severely undervalued, we will let you know. And in fact, if we zoom out to the last 5 years, not that often, but there are time periods where this company is given to investors at a very attractive opportunity. Nonetheless, even though it is slightly above the upper end, great to see over the period intrinsic value has been increasing. And it's also one institutions like on the lower side for ownership at 17%, 20 billion worth of shares sold in the last year, 50% more buying, and we also see nearly twice as much buying in Q2 2025. If you want the reverse of the trend, well, by quite a small distance, you would have to go to Q2 2024. Otherwise, more often than not, institutions do love this company quite a lot. Now, our intrinsic value gets to $272 today, the average of the 4 models that you see on screen. As always, when we do our deeper dives on the channel, we run through every single model, the inputs and the outputs. Today, getting straight to it, although we will flag the DCF, which comes a little bit lower, just really want to flag we've used a 15% growth rate moving forwards, and on a reverse DCF, essentially saying if you're buying this at market price today, baked in is 18.5% growth year on year. Now we have 10, 15, 20. As always, numbers are subjective. You can click on the pinned comment below and grab a copy of the model by using TSM or any other company. Now typically we like to kick off with a 10% margin of safety. This flags right now we see around 5. And the reason why we use 10, we essentially use this as a starting point, execute buy if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, then a buy at 245 will also show you at 20% a buy at 218 and at 25% a buy at 204. As of today, high quality company, 5% MOS, Wall Street with the strong buy, see this at 278 in 2026. That is 7% upside, but we do want to make you aware we are using the average price target. Some have it much higher in the $300 region. Stock number 1, TSM, give us your thoughts whether you see this as a buy, hold or avoid. Before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet of 29 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is ASML. Now this one is a bit of a roller coaster. It has decreased quite a bit, but it is starting to recover. One of the issues that investors did see is that in their latest earnings, the CEO did stipulate that they're unable to confirm the growth rate for 2026, all down in fact to what they say is uncertainty from ongoing tariffs. And we also had news just days ago actually that the company did invest around $1.5 billion into a startup company. Now they are holding around 11% ownership, and it will be interesting to see where this partnership goes. Now Mistral, the company itself, as highlighted, develops AI models and chatbot, so good to see ASML are looking at other opportunities for shareholder return. And actually, if we look in the last 90 days, in fact more specifically, we are seeing some insider buying, which is always what we would consider a bullish signal. 4 insiders in fact have been acquiring shares, with the largest one being around $590,000. As we can see, notably we are talking just days ago. And as always, reason why we call it bullish, as Peter Lynch said, insiders buy because they believe the share price will go up. And it's not just insiders. In fact, the company itself have been doing share buybacks. Granted, they do have in fact a 12 billion authorization program, of which they have used around 50%, but if we look at the beginning of the year, they have started to accumulate quite a lot of shares from the period of January towards the end of July, and we're looking at prices that aren't too dissimilar from the current trading value, meaning management themselves believe the share price is undervalued. And in their latest earnings, top line was up 23% year on year, and very similar to TSM, we do get a company that is, as highlighted here, improving efficiencies. Now they're only up 1% over the last year. Year to date, they're up around 17%. Over the last 10, another serious outperformer, trading not too far off their 52-week high, with a double buy from both Seeking Alpha and Wall Street, and their growth slightly on the lower side at a C+, unlike TSM, little bit more of the cyclicality shining through, 26% growth last year, 10% expected this year, which yes, on both accounts, is higher than the sector overall, but we do notice their 5-year average does sit a little bit higher. Earnings per share also pretty much a similar conclusion, 16% projected in the next 3 to 5 years, little bit above sector, but as highlighted, their 5-year has shown their growth to be above at 22, and even with 4 out of 4 beats in the most recent earnings, out of the next 4 they're only predicting 2 of them to be growth, trading at a forward PE on next year just below 27. Now forward PE, we do notice, unlike TSM sitting below 30, which is in fact below their 5-year average with a yield higher, both of these signaling potential undervaluation, of which is also the same conclusion on the blue tunnel, although just about, meaning pretty much for most of the last 12 months, ASML was undervalued, mispriced by the market. But if we zoom out to the last 5 years, actually this is not a commonality. We notice many times where this company has traded either fair value or in fact severe overvaluation, so definitely one to take note of, even with the run up it has had year to date. And institutions with their 26% ownership, they've actually sold a little bit more than they've bought in the time frame. The same goes for Q2, although we notice the opposite in Q1, so actually a little less bullish from institutions as opposed to TSM. And we notice the intrinsic value getting to $909. Now this is solely derived from the DCF, where already you can see, in fact, on a reverse basis, 10.3 is baked in, meaning if you do use the lower rate today, downside of 2%, and we'll just highlight for transparency, so at 10% we can see $790, and if you want to be a lot more optimistic, why not, if you have faith in the longer term, at 14%, we're talking 29% upside. Now using the middle rate of 12%, we will ultimately get a margin of safety as our intrinsic price is above the current value, giving rise to 11%. If you want more at 15%, then a buy at 772. If you want a 20% MOS, then 727, and at 25 it does sit around the $681 mark. And with Wall Street, in fact, some analysts have started to increase their price target. We're talking 14% into 2026. Stock number 2, ASML, let us know your views, where you see it as a buy, hold, or avoid. We then move on to the next stock, which is Marvell Technology. Now, it's not a household name like Nvidia, but it plays a critical role in powering the AI revolution. Marvell designs and manufactures semiconductors used in data centers, cloud infrastructure, 5G networks, and high-speed connectivity. And what makes them especially important for AI is their leadership in custom ASIC chips. These are tailor-made processors that the biggest hyperscales like Google, Amazon, and Microsoft rely on to run AI workloads efficiently. As demand for AI computing explodes, hyperscalers are increasingly turning to custom silicon, and Marvell is one of the very few companies with the expertise to deliver it at scale. On top of that, networking chips, think high-speed optical interconnects and Ethernet solutions, are essential for moving massive amount of data inside AI data centers. Without this technology, AI could not function at scale. So while Nvidia gets the headlines for GPUs, Marvell quietly provides the plumbing and the brains that keep AI infrastructure running. That unique position makes them a powerful AI growth play for the longer term. Now, the company itself is down around 10% in the last year. Year to date, down 40 quite significantly, but over the last 10, even with this drop, they've managed to outperform, trading towards the lower end of the 52-week range. We get fairly attractive buy ratings from both Seeking Alpha as well as Wall Street, and their growth also impressive. We're talking 37% year on year, 20% expected this year. On both accounts, again, higher than the sector comparative. Likewise, they're growing faster than their averages. If we look at earnings per share, the conclusion again is the same, 32% in the next 3 to 5 years, above sector at 15 and their own 5-year, which already looks good at 26. And we also pretty much note green right across the board, with the next 4 quarters strong double-digit growth, lowering in anticipation for January 2027 their forward P to 18. Likewise, severe undervaluation, forward P 22 below the average of 35, and the blue tunnel, not only are we seeing that disparity between the current trading value and the bottom end, but it is also moving in the right direction. Definitely one for serious consideration. It hasn't taken off yet, and institutions with their 84% ownership selling 11 billion in the last year, they've bought a bit more, around 40-50%. They bought 3 times as much in the most recent quarter, and typically, in fact, are net buyers as opposed to net sellers, so this is one they also clearly like. And our intrinsic value of $84, again derived solely from the DCF model, is using a growth rate of 12%, already highlighting potentially you may see this undervalued. Baked in is 8.2% moving forward, so whether you use 10, 12 or 14%, each one does show upside. Using the middle rate though, we get 22% MOS. That already could seem very attractive. Wall Street themselves see this at $90 into next year, 36% upside, and for those wanting a 25% MOS, well, a buy at 63. We can always go one step further and plug in 10% using the lower rate to see what the MOS is for those that are interested, and you could argue still looking attractive at around 10.6. So Marvel Tech, let us know your thoughts. The next stock we're looking at is Applied Materials, the world leading supplier of equipment used to manufacture semiconductors, the chips that power everything from smartphones to supercomputers. And when it comes to AI, demand for advanced chips like GPUs and high bandwidth memory is currently skyrocketing. Now look, Applied provides the tools and technologies to build those chips at scale. Think of it like selling the shovels during a gold rush. Every AI chip maker from Nvidia to TSMC relies on their equipment, and that makes them a critical behind-the-scenes winner of the AI boom, with growth tied directly to the rising demand for cutting-edge semiconductors. Now, they did post their most recent earnings not that long ago. However, it did see weakness in China demand, which did really weigh on their results, and guidance for next quarter came in a little bit cautious, but still the chip demand is keeping their growth solid, and we noticed an 8% drop in the last year. Year to date up 3%. Over the last 10, another significant outperformer, trading around the midpoint of the 52-week range. Another healthy double buy from Seeking Alpha and Wall Street. Now their growth is ultimately what lets this one down more than the others, but remember, valuation will be slightly cheaper. We notice year on year 7%, expected this year around 3 to 4. It is lower actually, and no surprises, than the sector and their own 5-year average that comes around the double-digit rate. Earnings per share also reflected, sitting around 7% versus double-digit of both comparables, and they actually expect a drop in the next 4 quarters of their earnings whilst having a 100% track record, and that is why the forward P is only expected to lower very slightly to 17.8. Now currently we see it not too dissimilar from the 5-year average. The same to be said about the yield, 1.1% versus 0.9. This does imply possibly reasonable valuation, and that is exactly what the blue tunnel is saying. It is sitting right now around the midpoint, something we've noticed for the large part in the last 12 months, but actually when we zoom out to the last 5 years, whilst the blue tunnel has been increasing, this one more often than not, and in the more recent period, has traded severely overvalued. Now institutions with their 81% ownership selling 14 billion actually bought a lot more at 25. They bought a massive amount more in the most recent quarter, and if you wanted to see the reversal by quite some distance, Q2 2024. Now our intrinsic value of $215, the average of the 3, gives rise to quite a healthy MOS of 22%. If you wanted 25, again just to keep things consistent, a buy at 161. Wall Street see this $200 into next year, upside of 19%. Let us know your views on Applied Materials, but we will also flag if we were to just use the DCF model, the value does come higher at 226, of which we've used a growth rate of 6%. Maybe you see this as conservative, but just look on a reverse basis, 1.9. Let us know your thoughts on Applied Materials. And then we move on to Digital Realty, the leading data center REIT providing critical infrastructure where AI workloads run. As AI adoption surges, remember companies need massive storage and ultra-fast connectivity, and that is where DLR come in. They're the global network of data centers, which makes it a behind-the-scenes winner of the AI boom, offering not just growth potential, but also reliable dividend income. Now, the company's up 9% in the last year. Year to date, it is down. Over the last 10, it has marginally been outperforming the S&P, trading around the mid to upper end of the 52-week range. While seeking alpha's buy is fairly marginal, we see Wall Street not far off a strong buy rating. And with REITs, we want to look at their adjusted funds from operation and their growth expected over the next 12 months at 7%. Does sit above the sector at 3, as well as their historical last year 5 versus 3, so it is one of those that's growing faster than the sector overall, as well as seeing green right across the board, something we always love to note. Now, in terms of a forward P to FO ratio, 26 is above the 5-year, whilst the yield healthy at 2.8 does sit below the 5-year 3.2. Both of these do highlight potentially overvaluation, something that is reaffirmed when we look at the blue tunnel, although slightly just above, something we have seen pretty much for most of the last 12 months. This one does typically trade just above a reasonable signal. And if we zoom out to the last 5 years, whilst the blue tunnel has increased, this one more often than not does trade severely overvalued. Although 2023, around that point, it did give investors an opportunity. And finally, institutional ownership very, very high, 99.71%. Only 4 billion sells when we look at the buys in contrast, 4 times higher at 16 billion. Massive amount of buys in Q2 as well. Reversal sitting in Q1 2024. And our intrinsic value gets to $206. Now, what we notice is a 16% margin of safety. Not too bad already. At 20%, a buy at 165, and at 25, we can highlight 155. Wall Street themselves see this at $198 into next year, 14% upside, but let us know your thoughts on the REIT Digital Realty. As always, don't forget to subscribe to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.